Hello and welcome to Property Matters, a weekly look at the world of property designed to be of interest to anyone who has an interest in property. And Property Matters is sponsored by Town & Country, Property Auctions, London and also Fairview International. From LTVs to leaseholds, property is very much in the news every week. And of course, we'd love your views on the conversation we're having today. So please get in touch in the video comments below, of course, or if you'd like to get in touch via email, it's propertymatterstv@gmail.com. Joining me, as always, property expert Joe Joshi. Happy Mother's Day, Joe.
Yes, good morning, Paul. Happy Mother's Day to all the mothers out there today that are enjoying, and of course, all the mothers that we think about that we have lost. Of course, we lost our mother last year, and I'm sure she's looking down and thinking he's still up to his usual mischief on Mother's Day. So yeah, we're good to see, and it's turned out to be a nice day out there. I'm sure they'll be all going for their walks to enjoy that fresh air that we've now been allowed to have from the pandemic. So yeah, excellent, and hopefully they'll have a fantastic day, and we'll just carry on doing our bit. You know, Mum, just keep looking down us, and we'll crack on.
Well said, Joe. Delighted this week we have a mortgage special, and we have a special guest with us. Would you like to introduce our guest?
Yes, nice to have Bob Singh, an old friend of mine who's been in the. I won't embellish on the old part there, but he's been in the business for many years, and you know, his expertise lies in mortgages. I'm really glad to have him on board with us today. It's a crucial part of the Property Matters program because whilst I always try and supply all the properties that we can for our clients, visitors, and friends, without the money that Bob might be able to help put together, some of those deals wouldn't happen. So welcome, Bob, and hopefully you'll enjoy your time here today with us.
Thank you. Thank you, Joe. Thank you, Paul. Happy Mother's Day to everyone watching. Like you, Joe, I lost my mother as well back at the tail end of 2019, but I'm sure she's looking down on us as well, wishing us all the best. And I'm sure she's still telling me off. So for the things I used to do and annoy her, but yeah, we miss her. But yeah,
it's a mother's prerogative, of course.
Yeah, absolutely, yeah.
Bob, we've been talking on the show for some weeks now about how the process of transacting a property has changed so much during the pandemic, and the fact that the back end of the system is really struggling to cope because of people having to self-isolate, that kind of thing, and people obviously not being in the office together. How have you seen the whole process of the mortgage application change over the last year?
Well, we were an office-based operation, as were many mortgage brokers. Yes, you had that segment of our community that worked from home, who actually went out to see people, but I guess the busier ones who wanted to see 3 or 4 people a day had to have an office, really. But yeah, we've had to adapt and install technology. It's no longer possible to go and see people, so everything we did was remote control. Using emails, our own intranet system. Our mortgage industry is also evolving very rapidly. Technology is coming in every month, new ideas, new techniques to communicate with the customer, to facilitate the process. Now I can just send an email link to a client and they can fill out their fact find, upload all their documents and send it back to me within the hour. It's really moved on. So basically now we're working from home. We're doing Zoom calls, video calls, emails. It's a lot swifter. You get a lot more done, and you can work around your family life as well. So this pandemic, as much as it's caused a lot of deaths and heartache and business failures, it's maybe given us a new way of operating and working. And I'm not a I'm a technophobe, but I never used technology greatly before. I grew up when there was no internet. I grew up when we had to go to a library and using tracing paper to draw a diagram. We didn't even have photocopiers back in my day. So I've seen the changes. I've seen the changes in technology. But these days, a child is 6 months old and they're operating an iPhone.
Mm.
You know, technology is taking over.
Yeah. So, do you think that this new way of working, this new normal, if that's what we want to call it, is going to be the future? Do you think we are going to see a new way of working for good?
I think it's given people a different perspective. I think those that have the space in their houses will carry on to, working from their homes. But I think, yes, I think we all miss the office banter. We miss the Starbucks coffee. We miss the hustle and bustle of the city, because I think once you've worked in the city and worked in a very, very busy environment and you're suddenly taken out of it, you will miss it. So I think, I think a proportion of those people working from their homes will be desperate to get back to their offices.
Okay, well, we'll talk more mortgages shortly. Let's take a look at some of the news this week that's been going around. And increasing demand coupled by growing property stock shortages placing upward pressure on property prices. So the criticism here, this is a survey by the Royal Institute of Chartered Surveyors, saying, broadly speaking, that Rishi Sunak's simply done nothing other than pour petrol on the fire of house prices by extending the stamp duty holiday. What do we think, gents?
Well, I'll go first on that one, if you don't mind. I don't think he's actually poured any fuel on the fire. I think the reality is that, and I'll continue to say, property is the best form of investment. Everybody in this country, in the United Kingdom, strives to own their own home. The opportunities are what they are at this moment in time. And of course, the government is using the property to continue to fuel work and enthusiasm in building. And of course, as part of the property, the hub that the property is lets other industries like the DIY stores and the builders and the developers and all sorts of other carpets, etc. These are the industry that actually feed off that. I think people forget that it's easy to say he's done this and he's done that, but at the end of the day, it's important to see that the country has been through one of the world's biggest crises since the war, and to survive through that and keep the enthusiasm is what property has done. And of course, I'm a property advocate, and I encourage people to invest as much as they can. There is a supply and demand issue. That is probably more of an issue that people are saying, well, I'll hold back. And viewings are tough to do because of pandemic. People are feeling sometimes insecure of having people around their property. Those things are probably more a driver, Paul, in that sort of dryness in the marketplace of what is coming and available. But I think the reality of it is, it's keeping the jobs going. It's keeping the market going. Just look at the retail industry. What's happened there? Look at the the hospitality industry. I mean, they can't wait and count the days when 12th of April comes along, when they can actually start to open their restaurants and potentially open the hotels and so forth. So, it's been a very difficult journey. And the easiest thing, of course, as you know, is to pass the blame on to someone else and say he's doing that, he's doing this. But I personally think that we have done fairly well under the current circumstances. It could have been worse, but it's easy to say that they've done that. They've extended the stamp duty. People wanted that, and now, of course, we got the extension. People are complaining that it's causing a problem. So it's that the lesser of the two evil. You're never going to win. Whether you're damned if you will and you're damned if you won't, sort of thing. So I think that's where I'm at. I think. It is a supply and demand, and of course the spring is here. The daffodils are out. The people are getting busier. There is, positivity in the air in sense of, where the pandemic is going, and I think that will sort itself out.
So, Bob, if you were the Chancellor, would you have extended the stamp duty holiday?
I would have done, because as Joe said, property is the lifeblood of UK PLC. Unless the property markets are kept active and moving, pretty much the allied industries also slow down as well. My only criticism, if I can call it that, of the budget is that the stamp duty extension announcement was left too late. I think had it been done earlier, a lot of the transactions that maybe have been aborted wouldn't have been aborted. And now you're trying to get people to move during the time when people are going to readjust to opening up again. So children are back at school, you know, the shops will start opening. And I think people's focus now is more on getting back to normality than actually moving. So I think that's why the stock has dried up, because anybody wanting to come on the market in January, February probably thought, hang on, there's no point, because I'm not going to sell it because these buyers are going to miss out on the stamp duty. Because obviously the first deadline was end of March, wasn't it? So had that announcement been made in early Jan or Feb, I think people would have then, or the impetus would have been carrying on after that. But
well, certainly the Institute's figures bear you out there, Bob, because basically the amount of transactions fell significantly in January and February, because I think people thought, well, if I haven't done it by the end of December, there's no way I'm going to make March. So you're absolutely right. That's what's happening. But of course, there's a three-way pressure here, isn't there? Because he's saying, yes, I'll extend the holiday. There's a new 95% guaranteed mortgage. And also, we've got people saying, well, do you know what? I don't want to sell during a pandemic. I'll wait till it's over. So we've got no stock and everybody being incentivized to buy. And all that's done is fuel the price. And of course, the irony of all this perhaps is the fact that the money you'd have saved on the stamp duty, you've had to pay on the extra on the price.
Yeah, and that's what will happen. In my neck of the woods, people are saving £15,000 per transaction. So where perhaps you're wanting to keep your own house and then buying another one, and maybe selling your current property to your own limited company, people are saving a lot of stamp duty. So, it served a lot of people well, I have to say. They have saved real money. But as soon as this is over, then yeah, you'll probably pay extra in the price because prices are going up and because there's no supply available. It's supply and demand, it's market forces, but maybe the timing is perhaps out of sync because people's minds and focus is now on, sort of getting the kids back in. Then you've got the summer holidays, planning, etc., etc. So I think this year we won't see that much of an uptake in the next 3 months because I don't think people's focus is on property.
Well, just looking at some of the figures that are coming out. So by September, it's estimated by Keller Williams that 576,000 transactions will have benefited from the stamp duty tax break, 77% of which pay no stamp duty at all, and the overall saving will be 2.8 billion. So that's over 500,000 homes will have changed hands and paid no stamp duty, saving nearly £3 billion. So that's quite an achievement, and it's interesting that this is exactly how the government got us out of the last crisis beforehand, wasn't it? And in boosting the enthusiasm, shall we put it that way, in property.
For property, yeah. And most of the stamp duty is paid by the south of England. People in the northern shires or the counties hardly pay any stamp duty because the average price is below 125.
Yeah.
And I think there was a report out in the papers yesterday that in 2020, 20% of the stamp duty was from prime central London properties alone. So London and the south is probably the biggest contributor to the treasury for stamp duty.
Yeah, I think I've got some figures later on when we're talking mortgages with you, Bob, that the average mortgage is £211,000 or thereabouts. So that gives you an idea. And from those figures, 77% will pay no stamp duty at all. You're absolutely right that the vast majority of the properties are going to fall below that threshold.
Yeah.
And that's why most of the noise is made about the stamp duty and the cost of it in the south, Bob, because obviously house prices, the average house price now in the south, certainly in London, is almost reaching £500,000. And so it's a huge thing. I mean, cleverly, he's actually expanded the stamp duty till September for anything up to £250,000. Because there has been a huge surge of interest in people moving further out of London and buying in northern country, northern part of the country and northern counties, where there is a much better offering of property value against money. So yes, of course, there will be a big cry from the south, because that is the case.
Yeah.
Having said all of that, I mean, the demand is still high on London. I'm still getting international buyers who are just waiting for the lockdown to be lifted so that they can actually start to travel and transact
Absolutely.
into London.
Yeah. Let's not forget, London is still the capital, if not of UK, the world. Everybody wants to live in London. You know, if you're an overseas investor, Chinese, Indian, they all want that W1 postcode, or the SW1 postcode, or the Hampstead postcode. You know, foreigners love central London property, and it's no surprise they've been whacked with another 2% stamp duty on top of the normal stamp duty. So if you're a non-UK national wanting to invest here, your surcharge is now, you know, 2% more than it was last year from April. So they know that these foreigners or the foreign investors will pay extra stamp duty because they have that affinity, that desire to own a London postcode property.
Mm.
Yeah,
Should that be higher? Because sorry, go on, Joe.
Sorry. I've always said that for international families, London is still the most safest haven, irrespective of recent attacks and crime that might have happened in small pockets. To a large extent, you're still fairly safer on the streets of London. And when I know well-to-do families, well-to-do business people, leaders, when they fall from their grace in foreign countries, the first place they actually end up and landing is in London, because they can still walk the streets, go into the local shops and not think about who they were to who they are now. It makes no difference to the persons in the streets of London. Imagine, we're talking just off air earlier on about people like Amitabh Bachchan, for example. You know, he could walk in London and nobody would really give too much of a trouble to him. The odd one might go up and say, "Hi, how you doing?" But most people do. But where he is in India, he has to have an entourage of, you know, 10 cars front, 10 cars behind, God knows how many people security wise, and can't leave his front door. It doesn't matter where it is. But here he can walk around Mayfair and, you know, the odd one might say, "Oh, there he is, he's a tall fella." Other than that, nobody really cares about it, you know, and that's why it makes this country very desirable. That's why everybody wants to come. I always say, as you know, Paul, my little line, there's a bigger queue in Calais for London, but there's nobody in Dover wanting to go to Calais.
Unless it's on a booze cruise.
As to who's more popular, you or Amitabh Bachchan?
Well, actually, you know, he's taken a little bit of he's taken a bit of a fall from grace. I'm right on his tail now.
Coming back to the stamp duty holiday just for a second, it's interesting that 116,000 are estimated to be able to make get the benefit from this up until the end of June now. So an additional 116,000 transactions will happen between now at the end of March and June, and then another 118,000 between, interestingly, this June to September period where we've got this reduced stamp duty benefit of 250,000. And I guess the point that you were making, Bob, which is very interesting, is that even when it's reduced to 250,000, 50% of those sales will still pay no stamp duty as well.
Yeah, I mean, this stamp duty holiday has kept us in the mortgage industry really, really busy. It's kept all the lawyers very, very busy. So, you know, from a selfish perspective, I'd like it to continue, but obviously it's costing the government, so I think it's got to come to an end. But at least it's staged. It'll give people a chance to save maximum now until the end of June. If they miss the deadline, all is not lost. They'll pay something. There'll still be a saving. So if you are looking to enter the market, I think now's your window.
Do you think there's a case, because there are a number of people are advocating this, Bob, and that is to abolish stamp duty altogether? Because back in the 90s, it was a tiny amount. It was hardly anything to, you know, the revenue the government got from it was nothing. No. And it's only because successive governments have raised it.
It's a big earner for the government. So, so I don't think it'll be abolished. But should it be abolished? Yeah, nobody wants to pay a tax on, you know, owning property. I think it should be abolished on maybe residential, because there's no tax on selling your residential property. So why tax you on buying a property? So maybe it should all be shifted onto commercial or the buy-to-let, where you are genuinely going to make money long term. So And the government, as you know, hates landlords. They don't want you to buy many properties because you're then worsening the supply situation for the first-time buyer. So being a government, probably I'd maybe increase the capital gains on buy-to-lets, but don't touch residential. Let people better themselves, because in the south, every house is worth more than £1 million typically, in the better areas. So those people are going to pay you inheritance tax anyway down the line. So I think there's better ways maybe to structure the stamp duty, but let's see what happens. I don't think they'll change it because it's such a good cash cow for them. A lot of money comes in on a typical buy-to-let in say West London. People pay £30,000 stamp duty right now. Before the holiday, it's a lot of money.
Perhaps a naive question. I'll put it to both of you. I'll start with you, Joe, on this. But we're talking there about a lot of the properties. 50% even after June will pay no stamp duty. The average mortgage is 211,000. It seems to me that the really wise thing to do will be to go and find a property up north somewhere that's really good value or perceived good value, and just do something like a buy-to-let. Is it just as simple as that, or am I being naive?
Not at all, Paul. I mean, with the communication of the network that is going to grow with the high-speed train network that is underway, all of these northern countries, northern counties are going to become more and more accessible. What the pandemic has done has made people think differently about the way we live and the lifestyle that we have and the value that we have. So I think part of the directive of the government doing what they do with properties at under 250,000 is almost saying, here is your window of opportunity for you to consider moving to other parts. And part of their strategy is that they want jobs and fairness created in the northern part of the UK, which has always been deprived to London. Because there's always going to be, it's a bit like the sausage machine, isn't it? There's got to be people coming into London, but as it does, London cannot hold and sustain all of those. So they want everybody to move further out. And that is one way of doing it. And it's not such a bad thing, really. And we've learned that we can work from home, and therefore life is very, very different. Also, the quality of life is very important. And that's something we've learned in this last year of the pandemic, of knowing that where there are crowds, things can happen in a different way. So I think there is a subtle direction that is being pointed. And that direction is, look further north, look at the opportunities. And you don't actually have to go too far, Paul, to get out and do that. I mean, literally, as you sort of step towards places like Luton and, the outsides of south of Birmingham, all of those areas, which, as a child, I remember was a huge trip to get to Birmingham. And it was almost like a 2-day plan. You take your parotas and your packed lunch and so forth, and you had to stop off and do that. But people do that in an hour now, whether it's an hour and a half of driving and an hour or so in the train. I recently spoke to a person that lives in Leicester, and they said to me that it takes them lesser time to travel from Leicester to London than it does from sort of one side of London to the other side of London. So I think the directive is there. I think the opportunities are there for them. And that expansion of stamp duty is a great window for those that are looking to invest going out of London itself. Not that we want them to all go, because otherwise I might not have a job. But the reality is that I might have to shift myself up there to keep my job going. But yeah, that's my thought. I think that I think this is just about balancing the tipped scale, which is always tipped in favor of London, to try and balance it and see if we can get some people moving in outside. And downsizing. There are, Bob will probably be the right person to give you an answer on that. But I know for a fact that 25 odd years ago, a lot of people took interest-only mortgages. And if you think there's a pandemic that we've just gone through, there's a pandemic in the property market that is probably not far behind, because a lot of those people were supporting those mortgages through either what do they call those things, endowment mortgages, endowment policies that really didn't do anything. Some people cashed them in way earlier, and now there is no way to support that. And this is an opportunity where they might say, okay, you know what, I can actually downsize myself, move a bit further out, and clear off and not have a mortgage anymore. And that is another recycling part that is likely to happen in the very near future, because that'll be the next bit of tsunami that we'll get. But you know, I'd take Bob's view on that.
Yeah, I think, yeah, to just go back to Paul's question, buy up to 250 up north somewhere as a buy to let, I think you've got to be very careful before you consider any property, because the main reason to, or the main question you should ask yourself is, why are you buying that property? Are you buying it for an income, a yield, or do you think you'll enjoy long-term capital gain from it? So, you know, when everybody piles in at the same time, you tend to overpay for property as well. So you've got to be careful what price you pay initially. Do your research and make sure the rent is enough to cover the mortgage and give you a real income after all your expenses, and see what your goals are, because my experience is all the buy-to-lets being purchased now are up north, because that's where the income or the multiples make a bit more sense. Because, you know, if you look at Liverpool, Leeds, Newcastle, you know, people are buying properties as far as those areas because the returns are good. You can get a house in Leeds for 100,000. I've done a lot of mortgages there for people like that, and flats in Liverpool for 150. You know, nice, you know, good-looking flats. So I think you've got to look at your goal. But yeah, I think buy-to-let mortgages up to 250 make a lot of sense if you've got money already to invest, and it's going to be, or the deposit is going to be the same level, about the same level of stamp duty you're going to pay here. So why burn that money on stamp duty in London when that could be your deposit on the buy-to-let in the north of England? Yeah, you know, and that stays in your hands, not the government's.
That's a really interesting perspective on it, isn't it? just what you pay in stamp duty could be your deposit elsewhere. Extraordinary.
Absolutely, yeah, it will be, yeah. But yeah, and Joe touched on interest-only mortgages. He's absolutely right, because people in the mid to late 90s did take interest-only mortgages because banks were offering them. It's only since 2014, after the mortgage market review, that the banks, you know, really tightened up on interest only, because they knew that people were lazy. They wouldn't really plan ahead and save alongside their interest only mortgage to pay it off at the end. But they're now making a bit of a comeback as well for the high earners only. So not everybody can still avail interest only mortgages, but for a certain level of income, for a certain level of equity in a property, banks are slowly opening up to the idea and being a bit more careful as to who they give it to. So, but we are getting a lot of cases, particularly in our Asian community, where the parents have taken interest-only mortgages. They're coming to the end of it and haven't saved up, haven't got any other assets to clear the mortgage, and now we're having to introduce the children onto that mortgage to use their affordability and their income to help the parents either extend that mortgage or buy the house from them, which isn't the best situation to be in from a parent's viewpoint, because, you know, you might lose your security of tenure. You know, if you're forced to, you know, transfer the house into your children's names, then who's to say they're going to keep you in there for the rest of your life? So, you know, people will find themselves in a precarious position, and they need to take advice as early as possible.
Thank you, Bob. That's very helpful. And encourage people watching to put their questions to either Bob or to Joe in the comments below the video. Please do so. If you have any questions, this is a great opportunity to ask questions of our experts today. So please, just underneath the video, put your questions in. They'll come up as if by magic on the screen, and we'll be able to answer them for you here directly. Let's just move into another quick story. Investment in residential property exceeded $6 billion in 2020. Information this week about one lender. Sorry, I beg your pardon. Looking at the fact that this was matching the all-time high of 2018, 6.1 being invested in bricks and mortar, and London was the heart of that. So again, Bob, this is substantiating what you say, if you like. 2.8 billion of that 6 was invested in London. But what's interesting is the rapid rise in the build-to-rent sector. So do you just want to explain that to us, Joe? Build-to-rent versus buy-to-let, in case people aren't aware.
Yeah, so build to rent. Let's just take a step back for a minute and look at what's happened. There's a lot of commercial property that has now become surplus to requirement based on the pandemic. For example, people working from home, so not as many offices are actually required, and companies have rethought their thing. The other thing that they've thought about is everybody else is actually jumped on this property bandwagon and want to convert bigger buildings and actually rent it out. So they've decided in some companies to actually convert or invest in blocks themselves in order to provide that rental accommodation and make it a bit more bespoke to the desire of the younger generation to incorporate in-house gyms and so forth, which has been coming, to be honest with you, it's been there for some time, but I think they're just trying to appease the new generation. So the ethics of, work, rest and play, the old adage of a very nice sweet that was made in Slough, is what they're trying to do, and say that, let's cash in on that. I mean, I've known of couple of big supermarket chains or department stores that have now decided that they'll convert some of their fantastic historical massive great stores that they had into apartments or into these rental properties, and some of those are in the heart of London that we never thought will ever be empty, but they are, and they are closed, and they've got to redo that. Someone else is going to do it. So their own shareholders are sort of saying to them, well, actually, why aren't we doing this? And why aren't we actually turning this into a business itself? So they must have an Indian financial consultant on their team to sort of to think that way, because it's the sort of thing that we would do, and look at it. But I think that is coming. The good thing about that, Paul, in my mind, is, and this is not a go at the buy-to-let market, is that it actually gives the first-time buyers a greater chance. Because imagine 100 apartments, and then 50% of those were going to go to buy-to-let. The problem when they go to buy-to-let is it actually alienates the first-time buyers to actually get on that ladder. But if companies convert and keep them themselves, they're not actually putting them out to the market, and therefore there's other properties that can still give first-time buyers a chance to get on the run of the ladder. Otherwise, a lot of the investors take it. And why are there big investors? The investors are always there, in my mind, primarily because there is nothing else. Zero, zip, nicht, or where they can actually put their money. Now, I know for a fact that people at a certain age are really not interested in leaky taps. I'm sure they'd much rather be cruising somewhere in the Mediterranean, and have an income from something that provides them an income and security. But because that doesn't exist, they don't want to sit and watch the screens for the stock market. They don't want to, there's no other investment type of circle, so they buy property. And that's part of the reason of the fuel of the property. It's nothing to do with the stamp duty and so forth. It's that this is the only secure form of investment that they can make. They'd rather have, if they got 600,000, 500,000 pounds, or even a couple of £100,000 sitting on the bank account, they'd rather go and do a buy-to-let with Bob in the north, save the stamp duty, right, and have an income which might give them 5, 6, 7, 8%, even up to 10% return, than have it sitting in a building society or bank that's giving them 0.01%. It's just it's a no-brainer. It's got nothing to do with stamp duty. It's just there's no other vehicle that is provided that gives them the safe haven to think that, what, I'll put my money here and I'll go on a cruise and I'll pick up a £1,000 a month because I've rent this. There isn't, and that's the issue as far as I'm concerned. There isn't another vehicle. That's why house prices and property in the United Kingdom is the best form of investment.
Yeah, Bob, it's interesting that this build-to-rent sector has grown by, well, it depends on the reports. Some say 20%, this one says 20%, another one says 40% in the last year. A lot of foreign money coming in because they realise that London, despite Brexit, is still a great access point to Europe. So it's a great location, as Joe was just saying.
Yes.
But I suppose the question is, 3.5 billion of investment in build to rent this last year. Is this yet another pressure on the buy to let landlord, or does this provide another alternative?
This is a no-brainer for the developers because many developers have a different strategy. If they're building 10 sites, they might sell 5 or 6 of them and keep the rest on a build-to-rent sort of scenario. And I think they look at their numbers and say, okay, are they making enough return on their investment for their investors by selling it, or if the land prices were particularly high and their margins aren't that big right now, they might decide to keep it and wait for the prices to go to a certain level and then sell the flats off at that stage. So I think this is purely a numbers game. It's a financial decision, and I think they're probably pushed towards that direction by the government as well, because there's a lot of shortage for social housing. So those sort of big blocks tend to go to the social sector first, because nobody really wants to rent in a place where it's not private. And I know that's a bit snobbish, but I've seen that sort of comment made by people that if it's a ex-local authority type rental sort of scenario, they don't want to stay in that sort of block. So I think you'll find they'll probably give the whole block to one organisation rather than try and let it themselves one by one. So I've seen that happen a lot as well. They just give it to the local authority and say, okay, you put your people in there. We just want this much per month, and we're happy. In 5 years' time, we'll come back and review it. If there's a good gain for us to be had by selling it, we'll sell it. If not, we'll rent it again. So it gives the developers a bit of a mixed portfolio. They can diversify their risk by adopting the strategy to build and hold and rent, rather than build and sell and be done with it.
Just want to talk mortgages a little bit more, obviously, as you're here with us, Bob. We did hear in the budget of the new mortgage guarantee scheme, 95%. Tell us a little bit about that and what perhaps we should be aware of, because there is some devil in the detail. Obviously, if you've got a little bit more deposit, you're going to get a better deal. So how does that all work?
Yeah, well, 95% mortgages aren't new, of course, because they were around before the pandemic. They were rapidly withdrawn as soon as they got the jitters, and even the 90% schemes were hard to come by, and everybody had to put down a 15% deposit last year. So 95% mortgages aren't new. Now, this has been bought again to revitalise the property sector. So the government is doing all they can to help first-time buyers. Now, this scheme comes in and it's pretty much replicating the old scheme of the 80s, which was the mortgage insurance guarantee premium. Now, that was where the banks would lend 95%, but they would insure the top 20% of lend through an insurance company. That was called the mortgage indemnity guarantee premium, and the customer would pay for it, but it protected the bank against any loss in the event of repossession. This is not too dissimilar, except here the insurer is the government, not the likes of Legal & General or Aviva. So the government is actually guaranteeing the top 20% to the lenders, and in return there will be a premium to pay. Again, that will be picked up by the client. The rate is higher. You'll pay a lot more on a 95% mortgage than you will pay for a 90% mortgage. So, and the fees will be slightly larger as well. So there is a price to pay for that 95%. I don't think it's going to be particularly attractive, because you could use the alternative of the Help to Buy 95% scheme, but there you have to buy a new property, and there's a regional capping now. But on this one, you can go as high as £600,000. But the scheme will only be offered on a 5-year fixed rate. That's the anticipation. So you'll be locked in for 5 years. It'll be a 5-year fixed rate, but you'll pay through the nose to get it. So let's see how it works. The finer details haven't been announced by all the major lenders. It'll only be available from the High Street bunch initially. I can't see the specialist banks getting into this space because it's not really their baby. But if it suits your purpose, if you can get the house of your dreams by using this scheme, then it can't be knocked.
Yeah, I guess that's the point, isn't it, Joe? Really, it's not necessarily the best deal on the market, but if it's your only option, at least it's an option.
It's a step on the property ladder run, really, at the end of the day, and that's what happened, as Bob said, in the early sort of 80s and so forth. That's when they started to do the same thing there, pushing at 95, and in some cases we had 100% mortgages. That may actually even show rear its head as time goes on, because the idea is to motivate the potential buyers to buy their property, and as Boris has said, he wants to create a generation of buy, not rent, going forward. And therefore, he's going to, do as much as he can. And because maybe he didn't get a buy-in from high street lenders or other lenders, as Bob says, is not their baby, he's had to almost stump up that to guarantee themselves as a government. But then the government has stumped up a hell of a lot of money in this last year as a guarantee too, to keep us all kind of afloat. You can't really knock their efforts. But I think the reality is that all opportunities go back, and I go back to my earlier comment that there is no other method, there is no other vehicle that encourages people to think, well, I'll actually invest and be secure elsewhere. And the only investment and security is the subject that we discuss every Sunday morning, week in, week out, called Property Matters. Because property does matter. It matters to everybody in every shape or form. One of the top 5 subjects on everyone's dinner table, which will come back soon, guys and girls, because we'll all be able to sit around those dinner tables. At the moment, we have to sort of distance it, but as that comes along, one of the top subjects is moving home. And it will never change. It won't change. It hasn't changed in 40 years that I've been doing this, and I don't think it will change in the next 40 years. I probably won't be around for the total of those 40 years. But when I look back, I was having a conversation. To give you an example, I had a conversation with my daughter the other day, and she said, "Oh, Dad, something's happening on the house. That bit needs doing, and so forth." And I said, "The house is 200 years old." So that just puts it in perspective that, 200 years ago, that house was there. And to be honest with you, 200 years after, unless I knock it down and put another one up there, it's still going to be there, but we'll be come and gone. And that's the journey that we're all on. In the meantime, it's a case of saying what works for our family, what works for us individually. And property does matter, Paul.
Yeah. Just to add on to that comment I made earlier, this 95% mortgage is available on repayment only. They will not offer interest only. But there are other ways of getting 95% mortgages. So whilst this is good and innovative, and it will be used by many, many people, there are other ways we can do 95% mortgages, and that's through parental assistance. So if the parents have a bit of cash, we can put that on a side account and use that as the buyer's deposit, but it belongs to the parents, if you like. It's still their money. We can help them that way. And there's another method where parents can give a charge on their house to the tune of, say, 20% of the value of the child's house. And that way we can help them get the 95% mortgage as well. So, there's lots of other ways as well. So it's not just this scheme. So if your child is looking to get 95%, do explore the other options available on the market. And for that, you need to speak to somebody who's got whole of access market, can deal with all the lenders to make sure the right solution is found for your particular situation.
Bank of mum and dad. Last point this week, which I'm glad you're here for this, Bob, because this literally did come out this week. One of the lenders is planning on having a locked mortgage for or a locked rate for the 40 years. So one lender looking for repayments at the same level for 40 years, up to 40 years. It's the longest fixed rate deal on the market. This company is saying, Joe, basically, and Bob, that the days of 2-year fix, 5-year fix is no longer relevant. It doesn't help us in trying to buy a house because we benefit from the rate, then we scramble around every 2 or 5 years to try and find a new rate because the rate's going to be so punitive that we had on the previous deal. So why not have a product like this? They're popular in France and Germany and Denmark and the US, for example. So why not have a mortgage that stays with you, and it's a locked rate, so you know what you're paying for the entire duration that you've got the mortgage. It makes sense, Bob, surely.
It does make sense, yeah, and you're right. It's very, very popular in the States where people typically take 25 and 30-year vehicles. This is new. It'll take some time to get your heads around it because we're typically in this country accustomed or sold 2-year products. Now, I can't remember the last time I did a 2-year deal. We tend to go for 5 years for first-time buyers and even buy-to-lets, because what people fail to realize is after the first 2 years is over, you've got to renew it. And that means paying another setup cost and possibly another broker cost as well. And then again in year 4. So in a 5-year span, you've probably changed or been charged 3 sets of fees. Now, if you translate that all into a percentage cost, you'll find you would have been better off with a 5-year rate in the first place, because there you've only paid 1 fee in that 5-year space. So it's a good idea. This is from Habito, this particular product. But it's a 40-year deal. That means, because most residential mortgages can't go beyond the age of 70 because they're regulated products. So the beauty of this one is there's no exit penalty, which had been the issue with the longer products available previously, because there were 10-year products, there were 15-year deals, but nobody ever took them because nobody wanted to be locked into that bank for 15 years just in case they had to sell or move. But when there's no penalty, it becomes a different proposition altogether, because you're buying yourself security. But on the other hand, you've really got to consider, how can an organization give you that money for such a long time at such a low rate? And that's because the markets really don't expect rates to go higher. Long-term money is dirt cheap at the moment. A 5-year buy-to-let mortgage with a 40% deposit is about 1.8 to 1.9. Money is cheap. I've paid 18% on a mortgage. Yeah. I'm sure Joe has as well. So when you look back and think, hang on, 18%, and now I can get a 5-year deal for 2%. The long-term projection is that money will be cheap for a long, long time, and this is why these fixed-rate products, which are based on gilt prices, can offer you that low security. And I think it's not a bad idea, because if you're not going to move for a very, very long time and it's not a big mortgage, you might want to pay a bit more for that peace of mind, just in case rates go up, just in case there's another financial disaster. But in the West, more so in the UK and America, we couldn't tolerate a rate rise. The economy would crumble. If your mortgage rate went from 2 to 3% or even 4%, I think everybody would be on their knees. The buy-to-let market would be on its knees. So, because the Bank of England controls inflation, I don't think rates are going to increase. I think 5 or 10 years is probably as long as anybody should really consider, because 2.99 is not a cheap rate. Residential mortgages are half that price on a 5-year basis. So you really got to be sure about what you take. And do you really? I think the rate on the screen was 2.99, was it?
Yes, it was. Yeah.
Yeah, and compare that to a 5-year rate now, it's well below 2%. But you will be locked into a 5-year rate, but you're not locked into this one. That's the beauty of this particular product. And the rest is on, how much will they lend you? Is it going to be the right deal for you? Can you overpay into it without penalties? So you've got to look into the product a bit in a bit more detail and ask your advisor, what does this product do for me? Is it good for me? Because it's the advisor's job to recommend it or not. You really got to have an in-depth discussion to understand your finances now. Try and predict your finances in the future, and then see, can you work with this product? Is it going to work for you tomorrow, the day after, next year? And then only take product if it fits the bill.
In your experience over the last 12 months or so, Bob, how has the process of, say, me applying for a mortgage with you, how has the process of getting that mortgage approval changed? Do lenders need so much more information from me now?
The information is the same, but they want a bit more now. Yeah. Okay. It's no longer about income or pay slips or tax returns. It's now, what industry are you in? Were you affected by COVID? Yeah. Have you been furloughed? If you are, when are you going to go back? So there's a lot more details around the pandemic issues that have been caused by COVID-19, because if you're, God forbid, in the travel sector or the hospitality sector, getting a mortgage is, nigh on impossible, because they know that you're furloughed. You may or may not go back to your job. Your restaurant business may not reopen. Your travel agency might not, get the bookings it needs to keep going. So they're now looking very closely into the sector of that applicant as well. The position wasn't helped by the pandemic, because banks were all working from big, fancy offices, and suddenly overnight they had to transfer everybody from office working to home working. So that caused huge backlogs, and some lenders to this day haven't even recovered from that. So some lenders are taking as long as 4 months to get an offer out, and the better ones are managing it now within say 10 days. So lenders' own technology issues have played a big part in it, but for the broker's part, it's a little bit harder. I'll be honest with you. They do want a lot more information. They do want a lot more explanations, but it's more around how the pandemic has affected you. Yeah. So it's a lot more paperwork, but it's okay. We get through it.
The one question that I can hear being shouted at is how much can I borrow and how's it worked out?
Okay. Lenders have varying ways to work this out. Now, the old system was a multiple of incomes. So they would ask you, what's your gross annual income? And they would apply a multiple. Now, back in the day, so in the 70s and 80s, that multiple was just 3 times income. Then it became 3.5, then it became 4. Now, for the professional market, i.e. doctors, dentists, and that sort of stuff, they will be given 5 or 6 times income. But Joe average, Mr. and Mrs. Standard 2.2 kids, lenders work on sort of 4.5 times as a starting point. And you said earlier that 95% scheme might fuel the market further, but this scheme was launched after careful consultation with the banks. And on this particular one, they're not really going to let people borrow more than 4.5 times income. So they are sort of cooling down the temperature by applying a loan to income ratio of 4.5. Now, some banks will go to 5.5. So that's those lenders that work on a multiple of income basis. And for self-employed, they'll work off the net profit before taxation figure on your self-assessment form. Some lenders will just take the latest figure. Some will average it over the last 2, and some will average it over the last 3 before they apply that multiplier. So if you've just been in business for 1 year, then we also have lenders that will do just 1 year's trading, and they'll just look at the bottom line for 1 year and base it on that figure. Now, apart from multiples, other lenders have affordability models. So they don't work on multiples. They look at your income, they look at your expenditure, they sort of take the statistics from the Office of National Statistics, from the ONS, sort of work out what a family of 2 would need to live off, and deduct that from your net income, and then see what size mortgage they can afford from that residue of income. So they've got these fancy calculations in the background, and that can often give you a higher borrowing entitlement than the multiples. So, we have a clever sourcing system that we use. We put your income in, expenses. It'll tell us which lenders are likely to lend you the most money. And the difference between the maximum and the minimum is quite stark sometimes. So it all depends on lenders' risk profiles.
And how are the charges applied? Do you charge a fee, Bob, or does it come out of the cost of the mortgage?
No, we're making up a success fee. So we'll charge you a fixed fee on completion. Only if we get you the offer. We'll do all the research, all the application is at our expense. So if it's successful and you draw down on the loan, yes, our fee is rightly due. The lenders also cover some of our costs. So they will pay us a percentage of the loan as a introduction fee. And these fees are typically channeled through networks or mortgage clubs, and they take their fee before we get our cut out of that. So people think it's a lot of money, but after taxation and expenses, it's not. So we have to charge a fee to cover our costs. And I'm sure everybody knows we also get commissions from any building insurance we do. We also get commission from any life insurance we do. So, you know, if we make enough on the others, then we may not charge such a big fee. You know, we're not here to take a fee and then run off, because this is a long-term relationship. You know, we want you to come back again in 3 or 5 years' time, recommend your friends. So we, you know, it's a business decision for me as to how much we charge. But if it's a £10 million buy to let, then I may not charge at all, because the commission is quite handsome. So why charge the client when you've covered your costs at all? So it does depend on the deal. Now, if you've got adverse history and there's a lot of issues on your income proofs, and it takes us a lot of time to actually work on you, yes, you know, we might even charge an upfront fee in that case, because it is generally hard work. One case can take a whole day to research in some cases, because you've got to make so many calls, so many calculations, consider this, consider that, before you recommend the right product to the, you know, to the client. So it's a lot of work. People don't really see it, because, you know, some brokers unfortunately will work for nothing, which is fine by them. But you know, we have a practice, we have an office, we have a team behind us who process these mortgages. You know, I offer the advice and the consultation and the expertise. But, you know, there's a cost to a professional service. You know, you pay your solicitor even before he lifts a pen. And we don't take our money until the end. So, you know, we're trying to be fair where we can. But yes, there is a fee for using Chess mortgages.
I understand, Bob, that you have a program that you're doing at 11 o'clock. Do you just quickly tell us what that's about?
Yeah, I have a Facebook group which has about 78,000 members. I do a weekly finance show on that. The group is called Professional Asian. It's run by a lady in Harrow. There's about 78,000 people on it. And I'm the sort of financial guru, if you like, on that group, and I do a weekly show where we talk about very much what you guys are talking about here. You know, we educate people on what's happening in the market, educate them on products, how we work, bring them news and views, and you know, it keeps them well entertained whilst they're having their prontas and their tea.
Well, look, Bob, I'm conscious of time because you need to go to that group, so we'll let you go now. So on behalf of Joe and I, thank you so much for joining us today. I hope that was of an interest and that we sparked a good debate there. And yeah, we'd love to speak to you again in the future.
It's been an absolute pleasure. So thank you, Joe. Thank you, Paul. And hopefully we'll meet up again soon. Thank you.
Indeed. Thank you, Bob. Thank you so much.
Bye-bye now. Bye.
So, Joe, interesting subject area, mortgages, and clearly worth talking to somebody with that kind of expertise.
Yeah, undoubtedly. We've always said that, you know, everybody has their niche profession, and Bob's been in the business for a long, long time doing mortgages, as you could see from his experience. And the two go hand in hand, because yes, whilst I want to be involved in the sale of the properties and advise what is done at the front, without the finance, it's not going to go there. So it's very important to try and bring on, and that's part of our challenge with Property Matters, is to try and bring on professionals that actually add value and give good guidance and advice and have longevity in the business, so that people can actually value that and enjoy it. And so yeah, it was great to have you on board, and hopefully we'll see him again.
And just wanted to wrap up the show this week with the new instruction at Crown Court Windsor that we got a rather flashy video on, which I'd like you to talk us through.
Yeah, well, you know, what do they say? A picture now paints 1,000 words, or in this case, a picture tells a story. So here's a video of a property that Fairview International are launching during the course of this week. It's a boutique development. We actually have been through the whole journey of this, Paul. It was a former pub called the Sebastopol in Clewer Hill, Road in Windsor, a very nice residential area. And the developer there has taken it down and got planning for 9 mixed 1 and 2 bedroom apartments. Quite quirky in their own way, very unique. Each one is almost individual. Lots of space, good square footage on each apartment. Definitely worth a view. Give us a call and we'll arrange times starting this week to show around. I've only got 9. I can give you an insight that we've already had a good number of people listed that have shown interest. A couple of them have already been where the deposits have been put in, so not many left. Do give us a call on Fairview International or contact us through Property Matters, and we'll be happy to arrange a time for you to have a look at it. Great opportunity. Good first-time buyers, of course, exempt from stamp duty. So because they're vacant, they are available to complete prior to 30th of June. So savings for stamp duty. Of course, they are available on a help to buy scheme and on the 95% mortgages if you so require. Perfect in every possible way. Just need to buy one.
You make it sound so inviting, as always. Joe, lovely. We've made it to an hour today, but I think we've had a fascinating discussion, and so much more we could have talked about with Bob, obviously, on mortgages, but hopefully we can save that for another day. So once again, thank you very much indeed, Joe, for your input, as always valued and always interesting to hear. And thank you for watching Property Matters with us this week. We'll see you again next Sunday.